Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. You know what? I got so many compliments last week about how well people enjoyed the show. And I couldn't figure out why so many in just that one show were so happy and complimentary to me. They received our videos, as so many of you do, on our emails. And I do want to invite the rest of you who are not getting our email for our video format to please make sure to contact us, get us your emails, because we send out this show that I do on the radio on air every Saturday morning on WWNL 1080 AM. I send that show out, and again, it's Saturday morning, 8:30 to 9 AM, to all of our email subscribers on video. So I get so many compliments last week on how people loved the show that received it on the emails, and I finally figured out why. It turns out last week's show, the screen was black, so people couldn't see me or anything. Now, what do you make of that? People complimenting on a show, the one show they can't see me. I don't know what to make of that. But in any case, I'm back. You can see me. I apologize for that. For those of you who want to tune me out and just listen on the radio, that's fine. I completely understand. Or listen just on audio. But I'll put the video out just for those of you who might still appreciate that too. But I am back, and I am taking up this week's show where I left off last week. And we're getting into a little bit of strategies on what happens if you need to use your own resources, if your parents or spouses or children are helping with the parents on spending for a nursing home. And if you are at the time of need and now there's no insurance in place and no prior planning was made, and you're just in a situation of where to pull the money from and how to pull the money, I expressed in last week's show that, number one, money trickles from your accounts to the nursing home, who is billing you for the expenses. Or if you're getting care at home, the home health care agency is billing you. So what's happening is it's causing a bill, a monthly bill or a weekly bill, or however they're billing, and you have to find the money from your own personal resources. So you go in and you write a check every week or every month. So let's say you're in a nursing home and the cost is $4,500 a month, for example. That might sound low for some of you and high for others, but it's $4,500 a month. So you go in and you write a check. Well, where do you write the check from is where I left off last week. So we look at the situation and we say, if I'm writing a check, that's a good question. So you call your financial advisor, or you call the attorney, or you call your tax professional, and they'll all three give you different answers. You say, wait a minute. My tax professional said take it from here because it has the least tax consequences. My financial professional said take it from a different place because that's the least earning fund savings account or CD that I had, least effective, let's say, or least efficient. And the attorney said, no, take it from over here because it's not a countable asset. So you say, oh my goodness, maybe I need to get all three of these people together. And you know what? That's exactly what you should do. You should get all three of those people together so that everyone is working together as a team, as I've said in so many other shows, working together as a team so that you can all, let's say, agree. And what you do is you make different considerations and compromises on what each component has to do to make things the best overall, best decision effectively overall even though it might not be the best tax alternative or the best asset drawing source that you could have chosen from. But overall, because of taxes, legal, and finances, and interest, it might be the best overall solution. So let me share with you some of the issues that you should be asking. Number one, should I pull from you have to look at where all your money is. Is it in IRAs, 401ks, annuities, savings accounts, investment properties, businesses? Where's your money? Then I want you to look at, where is your income derived? Is it just Social Security and pension? Or is some or all of your income derived from your assets? And if so, do you have certain assets that don't drive your income that you need on a daily basis, and other assets that you rely on that income for you or you and your spouse to survive on a daily, monthly, weekly, or monthly basis? That should factor into your decision on which asset you might want to draw from, when if you draw from one asset, it doesn't alter your lifestyle at all right now because it doesn't alter your income. And if you draw from a different asset, that is where you're getting your income from, and it might disrupt the income for either you or the other spouse who's not in the nursing home and needs that money to still live on and pay their bills to keep their house. What if the income's, because you'll get, we'll talk about the tax side of things, but what if the income is coming from the IRA and the non-income asset is from a CD? What if cashing in a CD causes no tax issues, and coming from an IRA, any amount that you add to deduct or just ask them to send you partial distribution from an IRA to pay the bills every month would be fully taxable? And what if an annuity is subject to an exclusion ratio if you have annuitized and only partially taxable? Or what if you cash in stocks and bonds and the tax consequence is that you pay tax at a favorable capital gains tax rate? Wow, what I just said should have sounded complicated, because it is. And if it's at a capital gains tax rate, it gets even more complex. Because what if you had long-term holdings in stocks that your ordinary income tax rate is 15%. So you're in the 15% income tax bracket. So you just figure, because you read the news, you read financial journals, so you know capital gains tax rate's 20%. I just read a book this weekend, a book in the bookstore, that says the capital gains tax rate on long-term capital gains is 20% for those of you in a normal income tax bracket. I just read that book, and it was too late to call the company. Folks, that information is wrong. For people in a 15% income tax bracket, your long-term capital gains tax rate has a very high likelihood of being zero, taxed at zero. And if you're in the 28% income tax rate, your long-term capital gains tax rate has a very high likelihood of being taxed at a more favorable 15% long-term capital gains tax rate. Folks, don't trust what you read and hear in these journals and news articles. Don't do it. Because I, as a financial professional, am sitting in the bookstore at 9 o'clock on a Saturday night doing what? I'm reading financial books. Okay, I don't have a life. I get that. It's 9 o'clock at night on a Saturday. Shouldn't I be somewhere else? But I'm not. And I'm in there doing the job for you so you don't have to. And I'm reading wrong information. And thank goodness for you, I have the knowledge to know it's wrong information. But you don't have that knowledge. Many of you. So back to this long-term care issue. You've got to get qualified financial and legal and tax professionals to help make sure you're not making tragic mistakes. Because giving wrong information can lead you to make wrong decisions, and wrong decisions on a large amount of money. I was just trained on last week and heard this from one of the top advisors in the country, leads to major mistakes. Small mistakes on large amounts of money mean large amounts of money. So I'm here to share with you that when we're dealing with long-term care issues and how to withdraw money and where to withdraw money, you might have tax-favored accounts from which to draw that have lower tax consequences. But wait a minute. In last week's show, I just talked to you about what happens if you have enough money to last 6 years in a nursing home, and the person in the nursing home only lasts 3 years. What if I, as a tunnel vision advisor, was saying, draw down from these stocks first because they have a tax-favored tax rate of 0% or 15%, especially if you're in the 15%, which means you're in the 20%, 20 or 28% ordinary tax rate that you would be paying, and that means you're in a 15% in many cases long-term capital gains tax issue up to a certain amount, making sure you don't break through the next tax threshold, income tax rate threshold. You might be taxed at only 15%, and I'll say, oh, that's a wonderful, wonderful idea. And then the parent or you or your spouse only lasts a year. I forgot to ask you a very important question. How is your parent's health? Because you might have answered me, oh, it's not good. Or you might have answered me, it's unbelievable. They're the healthiest people. They're going to live 20 more years. Hey, folks, it matters on this financial decision. Because the person who's in a nursing home with we have enough money to last for 6 years and they only make it 1 year, guess what happens if we did not touch those stocks? And then that person dies with those stocks all in their own name. We get for tax basis a step up in cost basis. So for tax purposes, we would have paid no tax on that upon inheritance and established a new cost basis to the beneficiaries. And we would have wasted that through short-sighted advice, thinking, oh, you're better off paying the 15% tax bracket than the 28% ordinary income tax rate you might have paid or your parents might have paid coming out of their IRAs. Do you see how complex this is, folks? It is this complex. Do we go to the CD? Do we go to the annuity that might have the exclusion ratio? Do we go to the stocks and bonds? Do we go to the assets that are in qualified accounts like IRAs and 401ks? Do we go to life insurance that has long-term care riders on it and annuities that have these long-term care riders? The answer is get to a qualified, comprehensive financial planning team, legal team, tax team, and health team, and have them help you sort out these highly complex areas to make sure you're making the best decisions in all of this situation, evaluating the whole situation instead of a narrow tunnel vision situation that you might be missing entirely. So that explanation, when we deal with spending down your own assets, most of the people I talk to never even realize this is an alternative consideration. I didn't even realize I need to think about where to get the money. I was just starting to take the money and cash in what was the easiest available, they'll tell me. I didn't do any of this planning. I didn't even know you could do all of this planning. I didn't know it made sense. I didn't pay anybody. I was just doing it on my own. And I say, well, that's the most expensive fee you can pay in many cases. You know, there is a saying, I have no idea who said it. Again, I read this weekend in a book that said, I know a president of Harvard said it, but I can't trust that now because I can't trust anything I'm reading in the books. But it said the president of Harvard said, if you think education is expensive, try ignorance. And that is exactly the truth. because doing it yourself might be the most expensive way to be providing these solutions by avoiding the fees of getting qualified, competent help. Now, let me tell you, there are a lot of people around in many fields, and they're not all as competent as others in those fields. You need to contact me if you have these situations and help me evaluate your personal situation and help you assemble a team of qualified and competent advisors. And that's what I can at least help you with the starting stepping stone for those of you who are faced with these dilemmas and don't know where to turn first. So you can at least turn here first. Now, what about tax deductions? We get to this situation where we say, hey, Jack, I'm paying income tax to pull the money, or not. Is any of this that I'm paying out tax deductible? And I will tell you that's a good question. It is different for all of you, because who's ever in the nursing home files a tax return, or maybe doesn't have to file a tax return. Maybe the income is so low they're under the threshold of filing a tax return. Did you know when you're retired, if your income is below a certain level, you know, even though you're receiving Social Security and all, that you no longer sometimes have to file an income tax return at all? Your personal exemption and standard deductions more than offset any countable source of income for taxes, your taxable income. And did you know all of your Social Security income does not come into play as all being taxable income? All of it's not subject to taxation. Wow. This is a complicated area, this area of financial planning, isn't it? And I'm only dealing with long-term care right now. So the question, is it tax deductible? I have to respond, every situation is different. Sometimes the expenses are fully tax deductible. Sometimes the expenses are partially tax deductible. Sometimes the expenses are not at all tax deductible. Did you know when we go to a nursing home that many people on their tax return put the whole cost of care at the nursing home as the tax deduction, if it's tax deductible, and that is not always acceptable by the IRS? It's not always correct. Did you know the IRS has codes and regulations that say the cost portion of care that's toward housing and food is not necessarily a tax deductible expense, but the cost for the care of the individual, the personal needs care, and the health care is tax deductible in some cases? So that you have to ask the nursing home to give you a paper that shows how much of the percentage of the monthly cost of care is a tax deductible expense. There, I just taught you something that many financial advisors don't even know. Many tax professionals probably don't even know that. But it can keep you out of trouble because you're declaring the whole cost of care in some cases that is not fully deductible. Who wants to spend down all of your money in a nursing home and then get an audit by the IRS after you're out of money, did everything else right, qualified for Medicaid, they're now paying your care, you get 3 years tax audits, and the IRS says you owe us a refund? Oh my goodness, where is that money going to come from? Right? So you're better off to do it right the first time than to try to fix a mistake. It is always better to prevent a mistake than to try to correct a mistake. So, partially tax deductible or partially tax deductible even no matter once you determine how much of the actual expense is tax deductible, whether it's 100% or 85% or whatever it is. Then you get to the tax return. And we as tax preparers look and say, this is an itemized deduction. So you have to first file a return. So if your income is lower than the threshold to file a return, it still might not be tax deductible to you, even though it's fully tax deductible. Wow, that was smart. If you say it's a totally tax deductible expense, but not for me. But that's how it is sometimes. And then you say, well, what do I need to do? Well, you first have to itemize, and you secondly have to typically the amount that exceeds the medical deduction which is 7.5% of your adjusted gross income. Anything below that typically wouldn't count on an itemized deduction anyway. It's 10% for some people, but normally seniors, it's 7.5% still. So you'd say anything below the first 7.5% of your adjusted gross income would not be deductible. Anything above that would, but again, subject to only the amount of tax that you'd owe. Because they don't give you a refund. The IRS doesn't say the full amount that's deductible is yours, and even if you paid no tax, we owe you a check. No, they don't do it that way. The IRS says it's deductible up to the amount of tax you would have owed anyway. So if you owe no tax beyond $500 and your deduction's worth $2,500, it's only good for $500. You get the refund of what you otherwise would have owed in tax. You see how that works? I'll share something else. Long-term care insurance. For those of you paying long-term care insurance premiums at different ages and stages, it's deductible at different levels and percentages. And there's also a Pennsylvania partnership program that's, for those of you in Pennsylvania, that's kind of required to get some of those deductions. So if you're paying for a long-term care policy that doesn't qualify for the Pennsylvania partnership program, those premiums paid may or may not be deductible. Wow, that's a lot of information, right? You may as well keep tuning into shows because I never know what I'm talking about each week, folks. I just come with you with all the information I have to share with you all the information that you're probably not getting access to help illuminate and illustrate so many different areas in planning that no one might be bringing up. Others might not be bringing up to you. If you're identifying that there is a solution available, sometimes that means identifying the problem you don't know you already have. Sometimes the first step in finding the solution is addressing a problem you didn't know you had. Someone points out a problem. Did you realize that if this, that, then this, that? No, I never knew that. You say, well, yeah, that could happen. Really? You get scared and you say, that could happen? Oh, yeah. And you look into it a little further and you say, wow, they're right. If this happens, then I could be subject to this. I better figure that out. I never want this to happen. And bingo, they helped you solve a problem you never knew you had. That's what I'm here to help you do, folks. I'm not here to teach you. I'm not here to educate you as to my job. As you can already see, it's way too complicated. What it takes me a minute to solve for you took me 38 years to figure out. And I'm still figuring it out. So if you have the next 38 years and you want to spend Saturday night at 9 o'clock in Borders and Barnes & Nobles and all the bookstores and going through the journals, or you can have someone else do that for you who likes to do that for some unknown reason. And while you're spending time with your kids and grandkids out at baseball game and hockey games, so you don't have to, you could spend time on the golf course knowing someone out there is doing that for you so that you don't have to. It's not that you couldn't do it, although you couldn't do it as well, but that now you don't have to. So that's why I bring out the show. It doesn't cost you anything to listen to the show. It doesn't cost you anything to share the show with your friends. I'm done for today. I'll be back again next week. We are continuing in this series. I thank you so much for tuning in. We'll be back again next week.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through SagePoint Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with SagePoint Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.